I'm sure you guys are doing fine today.
Good evening, sir.
Good evening.
So you're welcome to another class with equity professionals. In our last class, we looked at IAS 1 on presentation of financial statements. And I can remember that I gave you some assignments.
No.
And I hope you have you're able to touch on those assignments. If you haven't, it's not too late. Please, you need to go and review those areas that we did last week. They are extremely important. So today, basically, we are going to be moving forward from last week. So what I was able to achieve last week was that I have laid a foundation in terms of how a financial statement will generally look like. I've shown you a template for the statement of financial position. I've shown you the template for a statement of profit or loss, a statement of change in equity. Now, what we want to do is to start picking each items in those statements one by one. And I'll be teaching you how to treat each of these items in the financial statement. And that's how we'll continue until you are able to treat all of those items and you will be able to prepare financial statement comfortably. So today, the item we are picking is called property, plant, and equipment. And this item is governed by a standard called IAS 16. IAS 16 relates to property, plant, and equipment. Now, when we talk about assets, I told you, according to IAS 1, they can be classified into current assets and non-current assets. And IAS 1 gave us definition of a current asset. It gave us the definition of a current asset. And IAS 1 mentioned that any item that does not meet the definition of that current asset, then that item will be classified as a non-current asset. If you remember, one of the definitions given as current asset is that it is an item that is expected to be realized within an entity's operating cycle or within 1 year. So any asset that you cannot realize within 1 year is said to be a non-current asset. However, level of judgment is required. Certain level of thinking is required when you want to identify a non-current asset. Today, we are going to be looking at an example or a typical example of a non-current asset, and that is this standard on property, plant, and equipment. It is classified as a non-current asset, and you know why. Before I finish today, you certainly know why. Now, when it comes to IAS 16, what I'll be teaching you is basically how do you account for PP. I'll start with the initial recognition and measurement of PP. I will look at subsequent measurements by looking at items like depreciation, revaluation, and what have you. And finally, I'll look at the recognition and disclosures. All these are aspects of IAS 16 we are going to look at. And if you're able to understand everything I'm going to teach you, then that means you can conveniently account for any item of PPE. So as far as IAS 16 is concerned, it has nothing to do with biological assets that are related to agriculture. No, we are not dealing with that. However, there is an aspect of biological assets. They call it bearer biological asset. That aspect of biological assets would is part of IAS 16 to a large extent, but the focus is not biological assets. So it's not what you're looking at. We are not also looking at items like maybe you have a mineral right or an oil reserve. You're not looking at that. And why IAS 16 does not deal with this is that these are natural resources that you don't have to do anything. They are just there. It's just there. Mineral reserve. The minerals are there. Whether diamond, whether gold, whether oil, the popular one we have in Nigeria, we call them non-regenerative resources. It's just lying down, just be taking it out. So IAS 16 doesn't apply to all of that. So what is then this PPE we are talking about? Property, plant, and equipment. By definition, according to IAS 16, it said property, plant, and equipment are tangible assets. Tangible assets. Extremely important that you focus your mind on PPE being tangible, something you can see, touch, something that has physical substance. And this tangible item, they are held for use in the production or supply of goods or services, or for rental to others, or for administrative purposes. So we're saying here that for an item to be PPE, it must have three usage. Three. Number one is either that item is used for production or supply of goods or services, or that item is used for rentals to others, or that item is used for administrative purposes. So just think of any item that you are holding for use, not holding for sale, holding for use, to use it within your organization. So it's either you are holding it for production. Just think of any item that you can use for production, like your plants, majorly your plant in the factory, or any item that is used for supply, like a delivery van, or maybe an oil rig, or even all these internet service provider, that they use cable to supply internet, that their internet infrastructure. They use it to supply their own goods because their goods is that connection. You see, that cable, it's PPE to them because they use it in supply. For rentals to others, just think of any item that you rent to other people. It's PPE. Are you renting it to others? And the answer is yes, it's PPE. Any item. Of course, for it to be PPE, don't forget, it has to be a tangible item, something that has physical substance. And number three is for administrative purposes, like your furniture and fittings in the office. You know, those ones, you don't use them for production or supply, you don't rent them, but without them, the work in the office cannot go smoothly. Like your computer equipment, like your air conditioner, like your elevator. There are a lot of them. Those ones are PPE, but they are for administrative purposes. Even if you have a generator, office plant, your generator in the office is for administrative purposes. That's one. And any item that you have that performs this function, it is PPE if they are expected to be used for more than one period. That is extremely important. You must use it for more than one period. If you are using it for less than one period, then it is not PPE. Just expense it. Just expense it. I mean, if you are using it for less than one period, expense it. Put it in your P&L. You can call it stationaries. You can call it furniture and furniture, not capitalized. You can call it whatever name you want to call it. But as an FARC student, financial reporting student, you have to be comfortable with this definition and understanding of the concepts around this definition of PPE. A tangible item, a tangible asset held for use in the production or supply of goods or services, rentals to others, or for administrative purposes. And very importantly, they are expected to be used during more than one period. There are numerous examples you can have. The popular ones you would have motor vehicles, plant and machinery, furniture and fittings, air conditioners, computer equipment,
Delivery fan.
numerous. Okay, so that's the definition of PPE. Any question before I go to the next subheading? Any question? Okay. Oluwaseun, you said what of just a period, 1 year? That one is not PPE if it's just used for 1 year. It must be used for more than 1 year. It must be used for more than 1 year. 1 year. Any question, further question? Okay, if you won't ask any question, let me ask you a question. So if you have what do they call it? Stapler in the office. Stapler. You bought a stapler in your office. Does it meet this definition of PPE?
No, sir.
Yes.
No.
Yes.
You said no, sir. Okay, no problem. You said no, sir.
Yes, sir. It
So,
met it.
It meets this definition. But so if it meets this definition, so stapler should be PPE, right?
It is a tangible asset. It is for administrative purpose, and it is used for more than a year.
Exactly. But have you ever seen anybody
Hello,
put
sir.
stapler as PPE?
I think materiality will come there.
No.
It's
Hello.
Hello,
Yes,
sir.
you should go ahead.
Okay, I think it meets the definition for PPE, but it doesn't meet the definition or requirement of an asset.
Doesn't
Of a
meet the
tangible asset.
but it means the definition of PPE. I don't agree with that statement though.
It does not
PPE,
meet the definition of PPE
the first thing I
because
mentioned,
it's like
PPE is an asset in itself. It's an example of a non-current asset. So sorry, you can go ahead. You said it doesn't meet this definition. Yeah, I'm with you.
because stapler is classified under stationery, that it is used like to aid like office activities, not production activity.
Okay, yes, I see. What you have said is right, but truth be told, it meets this definition now. It meets this definition. It's clear, yeah. A stapler is a tangible asset. It is held for administrative purposes. And most of these stapler, you can use it for many years. Many years. You just be changing the pin. They will not spoil. You use it for many years. So truth be told, it meets this definition. But the challenge is this. Can we recognize it as PPE? Can we recognize it as PPE? So that goes to show that it is not all items, all assets that meets the definition of PPE that will eventually find its way into the books as PPE. There are some that will be expensed. And that is where the issue of materiality comes in. That is where the issue of materiality comes in. If the cost of that stapler, if it is material, you just add it as part of your probably maybe plant. If the cost is material, if it is not, that's why a lot of people just expense it. They will just expense it in the books. In most offices that I go, if I go for audit, sometimes I would prepare some of these costs. I will prepare it in the sense that I won't expense everything. I won't want to call it PPE because of materiality, but I'll just put it as prepayment. I will put it as prepayment. So a portion will be recognized in P&L this year. The remaining, I'll just put it as prepayment because we use them for more than 1 year. But you see, materiality is what separates those items and PPE. Materiality is important there. Now, having looked at the definition of PPE and having told you that it is not all items that meets the definition of PPE that will eventually be recognized as PPE, then what criteria must be met before you can recognize an item as PPE? Oluwaseun, go ahead.
Okay. Please, I have two questions.
Please go ahead.
The first, you talked about the last one you just said, you talked about materiality. So, who would decide the materiality? I think it would be in terms of value, or
Yes.
is there a generic
It's in terms
value for
of,
that?
yes.
While is, uh, the second one is, okay, maybe you answer the first one.
Okay. So usually when auditors come, they are the one that I'm sure some of you that are doing audits, they would really teach you how to set materiality level. Okay. Auditor will come and look at the reasonableness of your, they will do a sample of your transaction and determine a materiality level. Auditor does that. And internally, you as an organization, without even waiting for your auditor, you can say, okay, any value above 5 million, any item we buy that is above 5 million, we will capitalize it. Any item that is below 5 million, we will expense it. So there is no rule behind determining materiality. It's a matter of judgment. So you would see for some of you that are in practice, so there are some, let's say you have some furniture and fittings that they are not material. In the books, the way we would put it, we will call it furniture and fittings not capitalized. We would expense it in P&L. Even when the tax people comes, when taxman comes and sees that kind of item, taxman will even disallow it and say, this item is an asset, but you have chosen to expense it. You will say the taxman will not reckon with it. You will say no, but that's not where I'm even going today. But materiality is determined by the entity itself.
Thank you. So the second one is because I'm kind of lost, right? Because in my head, I'm thinking, how do we get this PP? How do we know the ones that are PP? Because you're saying that if there is more than a year, that's part of the characteristics. What if, like, let's say, I also now know, is it based on situation or is generic? What do I mean by that? Like that stapler example we gave now. What if that stapler got spots within the year? Would that affect it? Is it based on a situation? A situation now, or it's just that staplers or something like this? These are how we treat them. Do you understand?
Yeah, so it's just very straightforward. So any item you buy is very clear here. Any item you buy for production, for supply, for rentals, for admin, and of course the valued material, and you are expected to use it for more than 1 year, capitalize it and call it PP. And again, like you have mentioned, what if you now get spots within the year? Repair it now. Repair it. Then that cost of repair, we are still going to deal with that. We call it subsequent costs. So that cost of repair now is now another, should we add that cost and capitalize that one also, or should we expense it? So that's another question. I'm not there yet. But it is you that we will know from experience whether you want to use this item for more than 1 year or not.
Sincere apologies, please. I just want to just get this. What if it gets lost, missing, and I can't get it within a year?
Then you write it off. It's gone. You write it off from your books if
Okay.
it gets misplaced. Yes, or you get damaged or burnt. It's gone. You just put it in P&L straight on. Good question. Okay. Yeah.
Yes, sir.
Yes, I'm with you. Please go ahead.
Okay, thank you. From what you have, the example you have raised about the stapler, so it means that every other items that meet the definition of PPE, but because of their immaterial amount, right? So they should be expensed. Not only, I want to give a sample of if it is possible, like all these fittings like bulb, electrical items like that, that at least within a year like that, and we can use them and at least like that.
Yes, that's correct.
Hello, sir. Excuse me, sir.
Yes, sir. Yes, please go ahead.
Yeah, materiality, I want to say, is equally relative. What is material to one company may be very, very material to another company, depending on their size and operations.
That's correct. That's absolutely correct. Materiality is relative. Yeah. Yeah, very good. Very good. Okay. Having understood the definition of PPE, then when can you record it in your books? And that takes us to recognition of PPE. So recognition of PPE depends on 2 criteria. This one, you have to cram it, you have to know it, and it makes sense. Number one, it's probable that future economic benefit associated with the asset will flow to the entity. I mean, you don't have to put it like this word for word in case. The key thing here is that item would generate future economic benefits to the company. That's what this one is saying. It's probable that future economic benefit associated with the asset will flow to the company. Number 2 is that the cost of the assets to the entity can be measured reliably. You see, when it comes to future economic benefit, it majorly means that you must have control of that asset. Majorly means that the risk and reward attributable to that has been passed to you. You complete. I mean, majorly, you have heard of that before when I was defining asset. Then you would get future economic benefit from that asset. And future economic benefits, I mean, the easiest way to tell you is that it would either make money for you, save you costs, improve your operations. Future economic benefit is in various forms. And the cost of the assets to the entity can be measured reliably. Costs could either be the money you paid for the assets. There are some assets they can give you for free. So that means you did not even pay any money. Just get the fair value. So it could be the fair value of that asset if you didn't buy it. So that is cost. You see, when these two are present, that this item will make money for you, this item will save you some costs, this item will improve your operations, that means it will generate future economic benefit. And it must have a cost that can be measured reliably, either through knowing how much you bought it, or knowing the market value of that item today, but you must be able to measure it reliably. When these two conditions exist, please go ahead and recognize that item in your books. And how do you recognize this item in your books? A lot of you will know that you simply debit PPE. Assets are always debited. Then you credit either bank if you are paying for it, right? Or you credit, what do you credit here? Or you credit other payables. If you bought it on credit, you can buy it on credit. What if you were gifted? If you were gifted, what would you have credited? That's a question to you. If you did not buy it, either in cash or on credit, if you bought it in cash, you credit bank. If you bought it on credit that you're going to pay later, you credit other payables. What if somebody gave you as a gift? What will you credit?
It will only have debit entry. There won't be credit entry.
That's not possible. Accounting must have two legs.
Sir, please repeat it again. I didn't get that.
The way you recognize PPE, you debit that PPE, you credit bank if you are paying for it outrightly, or you credit other payables if you had bought it on credit. That means you're going to pay later, so you credit other payables. Other payables here will be representing liability. I now asked you that if somebody had gifted you the asset that you're not going to pay either now or later, but they gifted you, what would you credit? What would you credit?
Your asset.
Nope, you have already. How can you debit the asset and credit the asset? Anyone?
Tell us, please.
Okay.
Time.
What can you see?
Income.
Yes. Credit other income.
Okay.
Remember, the definition of other income, definition of income in the conceptual framework, he said income is an increase in assets. Increase in assets. So, your asset has increased by acquisition of assets, but now you didn't pay for it. Credit it. You credit it. You credit other income and debit the asset. This will be more clearer when I teach you IAS 20 on government grants. Then you will learn about when considered by government or whatever party, how do you treat such item in your books? And that's recognition of PPE. So what you need to know here today, as far as recognition is concerned, is your ability to never forget these two conditions. And as far as definition is concerned, you must be very comfortable with this definition. And in your books, this is how you incorporate it in your books. Now, when you have recognized this PPE in your books, then what amount do you put it in your books? What amount? And that takes us to measurement. Measurement. When it comes to measurements, there is always initial measurement and there is always subsequent measurement. Okay, Olakunle, please ask a question.
Yes, sir. In your definition of cost, you said the cost is the amount of cash or cash equivalent paid or the fair value of the other considerations. So when you say other considerations, what do you mean?
Okay, so that's really talking about if you did not pay for this asset. So if you not pay for this asset, that's one. And number two is that there are some scenario where there will be exchange of assets. Okay, exchange of assets. So maybe you have motor vehicle, you want to use it to collect generator. So usually the generator you are collecting, since you are not paying, you are actually collecting it by exchanging another asset. So you will just get the fair value of that asset you are giving up. Then that would be the fair value of this asset you are collecting. So
Thank you,
that's fair
sir.
value of other consideration given. I just want you to see that as if you did not pay. And it makes it more simple for you that way. Yeah. Okay. So we are on how much do you recognize it in your books? I mean, leave technicality alone. It's quite simple. When you buy something, you know how much you bought it now. You know it. So, but when it comes to IAS 16, and we are looking at measurements, then there is measurement we call initial measurement. That initial measurement is the measurement at the date of the transaction, the date you bought that asset. You would measure it at that date. And there's another one which we're going to look at later. It's called subsequent measurement, which is the measurement at the end of the year. As soon as we have addressed those two, then we will have learned how much measurement. So let's start with measurement at the date of the transaction, that you bought this asset today. Today, immediately you must recognize it in your books today. It's important to recognize it in your books today. And at how much? IAS 16 says that any item that you recognize in your books must be initially measured at cost. So you're going to measure it in your books at cost. And you already know what cost is. Is the cash or cash equivalent paid, or the fair value of other consideration given to acquire an asset. So breaking it down further, what is the money you have paid to buy an asset? The money you will have paid to buy an asset will comprise the following. Number one is the purchase price, which is usually the money you pay directly to your supplier, the purchase price. And this purchase price will also include import duties. Import duties. That's provided you have bought that item from a foreign country. If you have bought that asset from a foreign country, then you will have to import it. Then import duties would also be considered as part of the cost. And also is non-refundable purchase taxes. So usually, whenever you buy an item, any item you buy, the laws of the land of many countries will require that they will add VAT. They will add VAT. In Nigeria. In some other countries, they don't call it VAT. They call it other names. But because this standard is an international standard, so that users will understand what we are talking about and relate it to their own country. That is why they call it purchase taxes. Purchase taxes. The tax you pay when you buy items in Nigeria is VAT, because the seller will have added VAT. That VAT, you add it as part of your cost price. However, there are some VAT that you can go and reclaim back from your tax authority. You call it output VAT. I mean, you have suffered input. You can go to your tax authority and reclaim it. They will give you refund. That one that you can reclaim, that one you cannot capitalize that one. That is not what we are talking about. And usually, that one does not even apply here. Because any VAT that you can go and reclaim, okay, as output VAT, they are usually the ones or items that you resell. That is where you can have opportunity to charge VAT to your own final consumer too. Okay, so when you are eventually paying the tax to the tax authority, you just tell them that, okay, I charge 5 naira VAT, but I have also suffered 3 naira VAT. Take your 2 naira, you have gotten a refund of that your 2 naira. But in this case, that 2 naira, which is your purchase tax here, must be non-refundable. Of course, that's the characteristics of that of PPE, because you are not expected to sell this item in question, otherwise it will not be PPE. So, in summary here, for you to remember in the exam, these non-refundable purchase taxes, you can simply call it VAT. The examiner will let it go. I mean, you are correct from the Nigerian perspective, that are non-refundable. And of course, if there are any trade discounts or rebates, you remove it. You deduct any trade discount or rebates. Now, the examiner expects that you know the difference between a discount for prompt payment and a discount for bulk purchases. They are not the same. There are certain discounts that when you buy an item that you are not paying outrightly, but the guy will tell you that if you can pay within 1 month, if you can pay within 1 month, I will reduce your price for you. I will give you certain amount of discount. You see, that type of discount, you are not sure whether you will get it or not. So the cost price of an item, for example, is 100 naira. And your supplier, the person you bought it from, says that if you pay on time, you will not pay 100 naira. You will pay 90 naira. Then my question to you is this. In your books, would the cost of your asset today, because what we are talking about here is how much do you measure this asset today? Don't forget the scenario I'm giving you. You bought an asset for 100 naira. The supplier tells you that if you pay for this asset, he has given you the assets because you are buying it on credit. It's allowed. He now told you that if you pay for this asset within 1 month, you will only pay 19 naira. He will give you discount of 10 naira. So you as the accountant, they came to tell you that, this is the scenario. We bought this asset for 100 naira. But they say that if you pay on time, within 1 month, we will only pay 19 naira. They handed over the invoice to you. Are you going to recognize this asset amount as 100 naira or 90 naira? That's my question to you. Who can give it a try in this class?
100 naira.
100 naira, sir.
100 naira.
100.
Yes, sir.
100 naira.
Yes, sir.
100 naira. Fantastic. Fantastic. Are you now saying that discount I just sorry, say it again. Are you saying that this discount I just given scenario of is not a trade discount? Because
Yes,
for you
sir.
to so what type of discount is that?
That's a prompt payment discount.
Thank you very much, which you call cash discount, right? In the exam, you will see them calling it early settlement discount. Okay, fine. That kind of discount, let's say, for example, you eventually get it. How would you then treat it? Automatically, that means you expense it. You put it in your books as other income. Sorry, I said expense. You put it in your books as other income, discount received. But the discount we are talking about here is not early settlement discount. The discount I'm referring to here is a discount that you are given outrightly, trade discount. You go to the shop, you said, I want to buy these assets. The guy looks at you that, I like your face. For the fact that you have walked into my shop, don't pay 100 naira. The cost price is 100 naira. Don't pay 100 naira. The cost I'm giving you is 90 naira. Whether now or later, it's not attached to any condition. It gives it to you. Whether is that has to do with maybe you have bought a lot of assets and is impressed, or because you are a first-time customer, or because the guy is doing buy one get one free, or the guy is doing some promotion just to encourage people to walk into his shop. But the fact here is this: you get that immediately. The one that you get immediately, we call that trade discount. It is not attached to any condition. And immediately they remove it from your invoice in your face. You will see it. Cost 100 naira. Less discount 10 naira. Net 19 naira. Is 19 naira you're going to recognize in your book in that kind of situation. And that 19 naira will be your cost. And that's what we refer to here as trade discount. That is the amount you buy the assets, the purchase price, the import duties, VAT that are not refundable, and you remove trade discount and rebates, if any. It doesn't end there. There is also directly attributable costs of bringing the assets to the location and condition necessary for it to be capable of operating in the manner intended by management. You need to carry that asset to where you are going to use it. You need to put that asset in a condition where it will be ready to operate in a manner you intend it to operate. You see, any cost you have to incur for you to get the asset ready for use, we call such costs directly attributable costs. Again, any cost you have to incur for you to get the asset ready for use, that is a directly attributable cost. So picture this. Number one is the cost of employee benefits that are directly involved in the construction or acquisition of the item. So if there are some staff that are involved in the acquisition or in the construction of that PPE, they are directly attributable costs. Their salary for that period of constructing or acquiring the assets should be added to the cost of the asset. Let me give you a shocker. If one of your staff left his own primary assignment and followed you to the location where you went to buy the asset, and he was with you, you helped in acquisition of the asset, he used his professional expertise to help you acquire the asset until you bring it to the location. The salary of that staff for that day, you won't put it in P&L, but rather you should add it to the cost of the asset, because the guy his day was spent in the acquisition of the asset. Is a directly attributable cost. The cost of site preparation, when the asset is on site and you need to then get the site ready, you need to clean some sites, and like a clean example for you is if you want to build a structure, you now bought a land, you now have to spend money in getting that site ready. Then that's cost of site preparation. That's a more obvious example. That cost of site preparation, you are going to add it as part of your cost. Maybe you need to get some mallam. Maybe there is a lot of weeds on the land. You now have to cut them down. That cost should be capitalized. Another one is the initial delivery and handling costs. These will be transportation costs or packaging costs. Initial delivery is clear, is transportation. Handling is packaging. Handling can also be a scenario where you were stopped by Agbero, or these police people stopped and you had to give them some money. That money should also be capitalized, is handling cost. Because if you don't pay them,
We should capitalize bribes, sir.
what did you say?
Do you say we should capitalize bribe?
I didn't see that too. I said handling cost. I said handling cost. Going forward, Installation and assembling costs. So when you have to install and assemble the assets, and you have to pay some money to do that, capitalize it. Install and assemble, capitalize it. Professional fees. If you have to pay maybe a lawyer, maybe an architect, maybe an engineer, any professional that you know that you need to pay, maybe you need to sign an agreement depending on the nature of the asset in question. Maybe you will need an architect to do some drawings before you start construction. Maybe you will need any professional you have to pay, that if you don't incur that cost, the asset will not be ready. Professional fees, capitalize it. And finally, is cost of testing whether the asset is working properly. This is a scenario where you have an asset, like maybe a plant, that you need to run some tests on them. And you see, the cost of testing here will be probably maybe you bought some materials. You need to pay some people to run the machine. That's the cost of testing here. Is the cost of materials and the cost of labor and whatever other direct overheads that you have incurred. But in the exam, they will give you directly cost of testing. That should be capitalized. If it's the nature of an asset that you have to test before they can start working, then you need to capitalize it. However, any asset you have to test, of course, you will get an output. It's just for you to see that the output is okay. However, if you now get that output and you're able to make money from selling that output, again, the output from your testing, you were able to sell it and make some money from it. You see, that money you made, you don't put it as revenue because the asset was not ready when you made that money. For that reason, just use that output to reduce your cost. That is why this cost of testing whether the asset is working properly, after deducting the net proceeds of sales of samples produced during the testing. Have that in mind. These are the directly attributable costs. Funny thing is that ICANN can ask you to list this. So find a way to understand that these examples I've given you are the costs you will incur after you have, of course, purchased it and all of that. Then the cost you would have to use to get it ready. I mean, there could be other costs, but these are the primary one listed in the standard. Any other cost you incur to get it ready is a directly attributable cost, and they are usually capitalized. Okay, Techno, please. Before you ask a question, tell me your name, so I won't be calling you Techno.
It's your normal boy, sir.
Eh.
Latif.
Ah, yes, my boy. Go ahead.
Thank you, sir. I want to ask you this question. Let's say, for example, I just have to, we got a big machine that before we take it away from where we bought it, we need to buy up to 5 gallons of oil, all this hello.
Yeah, I can hear you now. Please go ahead.
Okay, those big oil that they use to service engine. So we just have to bought up to 5 gallons at least to test the machine there. So after we now tested it, we found it is okay. All those oil, they must have been, because we have used it, not yet fully black. We just have to sell it again. We can still sell it to some other people that they want to buy. They bought it and they use it for their own whatever, and they paid us for that. That proceed from that sale of that oil. So do you also capitalize that, or do you also remove that from the cost of the asset, or what, or we should just ignore it, or what do you think we should consider it to be?
Remove it from the cost. Remove it from the cost. See, The reason is this, right? That oil,
Yes, sir.
Latif, can you hear me?
Yes, sir.
So I said that the money you made from selling that used oil, remove it from the cost of the assets, right? And the reason is this. The reason is this. That oil was bought to test the machine. Okay? So
Yes.
it qualifies as cost of testing. So whatever the output from there, whether scrap or whatever money you have made as a result of selling that, okay, you use it. Don't go and put that as, because it's either you put it as income or you use it to reduce your costs. Either way, they have the same impact, right? So
Exactly.
use it to reduce your costs. It meets the definition of what we are talking about. Net
Oh,
proceeds from sales of samples.
okay.
Yeah,
Can I ask another one?
please do.
Okay. I assume that I have to go and buy new cars for my office. I bought
Okay.
up to 5. On our way coming, because we see many people at the bus stop, we just there to carry them, collect money before we deliver the cars at the office. All the money we get from that, what do you think we should do with this one?
Put it in your pocket. Don't report it in your books. Don't report that. That will be the money for the boys. I'm serious.
Does
That's what.
IAS still recognizes money for the boys?
Ajẹmọ́nú.
Yes. That will be money for the boys. So don't capitalize that, please. And don't report it when you get to the office. Okay.
Hello, sir.
Yeah, I'm with you.
I have a question. So, you gave an example that when you go with one of the staffs to where you want to acquire the assets, and then the person used their professional knowledge to help you acquire the assets, and then at
Yeah.
the end of the day, you have to acknowledge that person's salary for that day as part
Yes,
of the cost of the asset.
that's correct.
Do you think, smart now, do you think they will accept that kind you add that thing, that salary to the cost of the asset? Because I've come to realize that there are a lot of things that they accept as an accountant, and then the tax people go against in a lot of ways. So do you think that particular cost, the tax man will accept it?
Never. You will not. You will not accept it. Right? So, and the reality is that it's not like you want to start explaining to the guy. You want to start explaining to him that, how this part of my salary, it's just for you to write staff costs. The one that you want to expense, put it in your books. As part of the components of your cost, you have already put staff cost also there. And if the guy wants a breakdown of your PPE schedule, it is there. So it's not like you are omitting this cost. The guy is even happy, because what you are doing ultimately is that you are reducing your expense. The guy is happy. Okay, you want to capitalize it? Fine. Your profit goes further up. Abi? So it's not even a problem for the
Yes, sir.
tax man. Yeah. So very good question and
All
very
right.
practical question. Yeah.
Thank you, sir.
You're welcome. Good questions, gentlemen and ladies. But we are not done with the cost of an asset. Now, the third one.
Excuse me, sorry, please.
Okay. Oh, sorry. I muted you mistakenly. Can you unmute?
Yeah, please, I just
Okay.
want to clarify. It sounds somehow, but when you say capitalize it, do you mean add to the cost or subtract from the cost based on the scenario?
Add to the cost.
Thank you.
Good question too. Good question. Yeah. Thank you for pointing that out, right? Because a lot of people would not really get when I'm saying capitalize, and they will not ask. But thank you have asked it. So when I say capitalize, it means add it to the cost. When I say expense, It means put it in P&L. Okay, so please note that. Okay, now the third one, which is also part of the costs that you recognize at the date you bought the asset. We call that the initial estimate of the cost of dismantling, removing, and restoring the site on which the asset is located. You see, this cost of dismantling, removal, and restoration, sometimes we call it the commissioning cost. They call it the commissioning cost. Now, why is this one even coming to play? If you look at this cost very closely, we said the cost of dismantling, removal, restoring the site on which the asset is located. I mean, you don't require too much thinking before you realize that this is a cost that you are not incurring now. This is a cost that you are going to incur in the future. Because of that, that was why he said initial estimates. You can't know that cost with certainty. You can only estimate. So fine, estimate the cost you will use to dismantle the assets, remove the asset, and restore the site. And this is usually a requirement where there is a legal requirement that you need to do this, especially for those in the oil and gas industry, okay, where you need to do some drilling in a site and you need to probably will have destroyed that site. So the law of the land will usually require that you dismantle, you remove and restore the site back to the way you met it. They would have signed that agreement with you before you even start your project on that site. If that is a requirement, if that is a thing in this arrangement, then that cost you are going to incur in the future, that cost you in whether 10 years into the future, whether 20 years into the future, whether 50 years into the future, you must find a way to estimate that cost and include it as part of the cost of your asset. They will give you that cost in the exam. That is not a problem. However, if that cost you are going to incur in the future, you call a professional and the guy tells you that the total cost I think you will incur in the next 20 years is 100 million. Are you going to go ahead and recognize this 100 million in your books? Of course, no. We don't have future value as part of measurement basis. Remember, when I taught you IFRS story, when I told you conceptual framework, future value is not there. Exactly. Is it that you're having historical costs, or you're having fair value, or you are having value in use, or you're having current costs? What is obtainable now that we will need to use is current costs. Or probably you'll be talking about, current costs. So you will need to get like a present value. You will need to get present value of that future costs, right? And there is formula for that, okay? But the way ICANN is asking questions these days, they have advanced. They don't really require you to do that formula. And the formula is 1 plus r raised to power minus n. 1 plus r raised to power minus n. By the time you multiply that by the future value given to you, you get the present value that you recognize in your books. But you will see how I can ask it now. Instead of you finding that definition, they will have just given you the discount factor. They will give you the discount factor. So when they give you the discount factor, that is what you multiply by the future value. Then you would obtain your present value. So what we recognize for this C is the present value of that amount. So all through our study in financial reporting, this is not the only time we'll meet something like this. We are still going to meet it later. Anytime that we'll need to consider future amounts, don't let me tell you, immediately know that it's not that future amount we recognize in our books now. We don't recognize future value. It will be the current value today, which usually will be the PV of that future amount. Don't let me tell you again. But note that as far as this one is concerned, since we are not paying for it now, okay, so we will usually credit a provision. Okay, so when we teach you IAS 37, it's part of what we will teach you because it talks about this decommissioning cost also. So by the time you credit provision, the other leg you debit is PPE. Okay. Now, what I've taught you today is a potential 7 marks question. And I think, was it 7 marks or 8 marks? Between 7 and 8. The last time I can ask it, I think around 2 diets ago, is an area that, I mean, you need to be very
Hello, sir.
comfortable with.
Hello, sir.
Hello, yeah, that's it.
Sorry, you mean that we will debit PP and will credit provision for dismantling cost?
Exactly. Exactly.
So is it the present value that we are crediting or the entire sum?
The present value.
Okay, sir.
The present value.
Hello, sir.
Yes.
Please, on that same note, when you say debit PP, is it the dismantling that same property? You are going to add it to the cost of that property. Abi, you are going
Correct.
to have it as a separate asset.
As part of the cost of that item.
Okay. Okay,
Yes.
sir.
Yes. Okay. So this is initial measurements. When we are talking about PPE, you need to know this: purchase price, import duties, VATs, deduct discounts, directly attributable costs. You need to remember all of this. Then the PV of this future cost. You see, there is still more story to this, but I don't want to bore you with that now, because a lot of things happen later, but let's leave that for now. I will get there later. But just know this, then we are good. Now, going forward, you see, it's possible that some of these costs will be incurred over a period of time. There are some costs that will be incurred, like, for example, now employee benefits, staff costs. I mentioned that is only the portion that relates to the day the guy was involved in getting the asset ready. It is only that portion that you would put as part of the cost of the asset. Then further one you expense. So that applies to any other costs that you incurred like continuously. The one that you add as part of your cost of PPE is the one that helped you in getting the asset ready. That is the only one you add as part of the cost of the PPE. The one that gets the assets ready. Okay? The one that gets the assets ready. So that means immediately the asset is ready, any other costs you incur should be expensed. Okay? So also, even if an asset is ready and you are now making losses, maybe the asset, you are incurring costs or materials, the asset is not financially visible yet, and you are making pre-operational losses, you expense it. Don't capitalize that kind of cost. Or maybe when the asset was ready, you now had to engage somebody to come and train your staff to use it. Don't capitalize staff training. It's not part of getting the asset ready. The asset is already ready, just that we don't know how to use it. Or probably maybe the asset is ready and it's not performing up to expectation yet. So Any costs after the asset is ready. I'm sure you understand what I mean by asset ready. You see, the date asset is ready is different from the date an asset is used, though, right? An asset might be ready today and the company might not use it until maybe after 2 months. Any costs you incur after the asset is ready should be expensed. You don't include it as part of the cost of PPE. Please note that. Very important too. And that's what this paragraph is talking about. Now, this paragraph is talking about a fast forward of knowledge, right? So there are instances where you will have borrowed money to construct an asset. There is a standard called IAS 23. That standard says that the interest you are paying on that borrowing, that interest, don't expense it, but rather you capitalize it. But rather you add it as part of the cost of your assets. So take note of that. Even though it's not covered in this standard, IAS 16 didn't mention it. I will still teach you in IAS 23. I just quickly want to chip it in now so that in case you are solving a question and you see it, know that you should capitalize it. Any interest you are paying on money you borrowed to construct an asset, again, to construct an asset, not to buy an asset, to construct an asset. To construct an asset. That's it's very important that you understand that it's to construct, not to buy. The difference is that the one that requires constructing will mean that it will take a long time before the asset is ready. That's where you have to construct. So the interest you are paying, that interest, you will add it as part of the cost of the asset. If you see that, at least for now, just know that that should be capitalized. Okay, before we go to questions, there are certain costs that don't mix them up and treat them as directly attributable because they are not directly attributable. In May 2022, I can ask you, list 4 costs according to IAS 16 that are not directly attributable for 4 marks. My student came out and said, Mr. Wasil, that question was difficult. I said, no, it's not difficult. It's because you forgot it. So these costs that are not directly attributable are costs that you are incurring after the asset was ready for use. And what are these costs? Number 1 is cost of opening a new facility or startup costs or pre-production costs. I mean, the way to understand this is that when the asset is ready, you now did an opening ceremony. You spend some money, like the way Nigerian government does. And they will do an opening ceremony and spend billions of naira on that too. You see, that kind of cost, you do not capitalize that. You expense that. You expense it because they don't get the assets ready for use. They are costs you incur after the asset is ready for use. The cost of opening a new facility. Number 1, the second one is the cost of introducing a new product or service. And that will usually involve the cost of advertising and promotion. The cost of advertising and promotion. That should be expensed, not capitalized. The third one is cost of conducting business in a new location or with a new class of customer, which will usually involve the cost of staff training or relocation costs. These costs are never capitalized. They are expensed because they do not get the assets ready for use. Cost of conducting business in a new location or with a new class of customer. And the next one is administrative and other general overheads. These are indirect costs, clearly administration and other general overheads, like maybe rent, Like maybe you need to buy boots for those that are working in the factory, or those that will be operating the machine, or electricity for the factory, any costs that is administrative and general overheads, expenses. And last one is initial operating losses before the asset reached planned performance. So if you were making losses before the asset was able to be used optimally, that should be expensed. It's not part of the cost of getting the asset ready. Expense them. So 1, 2, 3, 4, 5. As an FR student, you have to know these 5. Cost of opening a new facility, or startup costs, or pre-production costs, the cost of introducing a new product, the cost of introducing or conducting business in a new location, okay, administrative and general overheads and initial operating losses. So these are, I mean, I kind of asked them to list it before, so why can't they ask it again? Question? Any question before we now solve a scenario? Okay. He says that. I'd like to read the requirement of the question first. So this question said, calculate the initial cost of the factory. Okay, that is what we have been talking about. It says that on 1st October 2006, Omega began the construction of a new factory. The cost relating to the factory incurred in the year ended 30 September 2007 are as follows: purchase of land, cost of dismantling, purchase of materials, employee benefit costs. It said further note in note 1, production overhead directly related to the construction, note 2, allocated general overheads, architect fees directly related to the construction, cost of relocating staff who will work at the new factory, then costs relating to the former opening of the factory, then loan interest, note 3. Okay. So they gave us some notes here, like this. So calculate the initial cost of the factory. So I will read the notes as I'm getting there. So I just need you to tell me whether each of these costs will be added as part of the cost of this factory that they are constructing. So, and I think they began construction in October. And when did they end it? Okay, they didn't give me that information yet. Maybe I've not read it in the notes, but I know that construction
They
started in
ended
October.
in September.
No, September is their year end now. September is their year end.
Year end.
So it doesn't mean that was when they finished construction, but I'm sure we will read it when we need it. So the cost of buying the land, are we expensing that or capitalizing it?
Capitalize.
Okay, that's correct. So the cost of dismantling existing structures on the site,
Capitalize.
capitalize that. So this one is related to site preparation, I'm sure.
Yes.
Purchase of materials to construct the factory,
Capitalize.
that's correct. Employee benefit costs. So we need to
Note,
go to
note.
one.
Go to note.
So note 1. This states that the factory was constructed in the 8 months ended 31st May 2007. It was brought into use on 30th June 2007. The employee benefit costs are for 9 months to 30th June 2007. Okay, this is what I was looking for. So that means they used 8 months to construct the factory. That means the construction ended 2007. And they started using it in June. That was when they started using the factory. However, the employee that they paid, the cost they gave us is for 9 months. This cost is 9 months salary. This 1.8 million. So how much are we capitalizing?
We
8
prorate it.
Okay, how do we do that?
8/9 times the amount.
As one.
Fantastic. Olakule. 8/9 times 1.8 million. That's correct. Because the construction only took place for 8 months. And this 1.8 million is 9 months salary. So they wanted to confuse us. They said that it was brought into use on June. They don't know that we already know that the cost that we capitalize is the cost that gets it ready, not when we start using it. So the asset was already ready in May, 8 months. Okay, and this salary for 9 months would expense 1 month of it. And the 8 months where they were actively participating in construction will be capitalized. Fantastic. The second one is production overhead directly related to the construction. Note 2. Let's go to note 2.
Capitalize.
Let's go to note 2. They said that the production overheads were incurred in the 8 months ended 31st May 2007. These include an abnormal cost of 200, which was incurred due to the need to rectify damage resulting from a gas leak. I'm not sure I mentioned normal loss or wastage. Any costs relating to wastage will be expensed. We do not capitalize that. Okay. So, and they said that this production overhead includes that abnormal loss or wastage of 200. That means
So we
what we are going to
deduct it.
capitalize is how much?
1,000.
The amount minus 200.
200.
That's
Exactly.
1,000.
1,000.
1,000. That's correct.
But sir, I have a question.
Please ask.
The production overhead were incurred during the period of construction, not after
Correct.
the item has been put to use.
That's
I
correct.
mean, when it
That's correct.
has been put ready for use.
That's correct. So now we are seeing that these production overhead are basically expenses, right? So they said some of them include some abnormal costs relating to damage. So any cost relating to either wastage or damage should be expensed.
Even if it falls during the period of construction.
Exactly. Even if it is all done in the period of construction, don't include it. And it makes sense because the value is not there. It's not there. It did not add any value. So just if you can quantify it and move on. But the reality is that we might not really be able to get this cost in reality, in real life, but you can get it, expense it.
So, sir, it therefore means that if we buy an item of PPE and probably while transporting it, it gets damaged in the process, the cost of putting it to its original state, are we going to treat it as we just treated this, or we will capitalize it?
You capitalize that because that one is a finished product already. It's different from asset you are constructing.
Okay.
So it's different from asset that you are constructing. And the reason why I said you capitalize that for a finished product is because you have not started using it. The asset is not ready for use. You have not brought it to your location and condition ready for use. And that's the only reason. Because you said when you were bringing it, it now got damaged. Or maybe there was an accident on the way. You capitalize that because the asset is not ready for use. It's only ready when it is in the location and condition ready for use. So the next one is allocated general administrative.
Is that not wastage?
Sorry?
Is that not wastage?
It's not wastage. It's different from wastage. It's different from wastage. Again, finished products, the way we see it is different from the one under construction. So whenever you see wastage, know that it has nothing to do with finished products or finished asset that you are just going to location to go and buy. Okay, the ones that can happen to an asset that you just went to go and pick, like a generator or a motor vehicle, is that there is an accident on the road or something happened on the road, right? That's the only one. If it's that the thing got damaged, you return it to the person that this thing is not good though, and collect another one. So you return it to the person. If the person refuses to collect it, you fight him, you ensure he collects it. You can collect your money, then go and buy it from another place, right? Any cost you have incurred to buy that asset that you did not successfully buy eventually, you expense those ones because there is not even assets in existence. But for finished goods, for a product you are just picking from the shelf, off the shelf, ready, there is nothing like wastage. There's nothing like wastage can only occur when you are constructing. So there are two different things entirely. You would never see wastage for picking off the shelf. I hope I've been able to clear that. Now let's move to the next one, which is allocated general administrative overheads.
General overhead expense.
Expense. Thank you very much. Admin overhead expense. Architect fees.
Capitalized.
Capitalize.
Capitalize.
Thank you
Professional
very much.
fee.
Yeah, professional fee. How about cost of relocating staff?
Expense.
Expense.
Thank you very
Expense.
much. Expense. What about doing opening ceremony?
Expense.
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 That's correct.
Expense.
Now, loan interest. I think this one is
Capitalize.
relating. Hold
Hold
on.
on.
There's a note
This
to
one
it.
is relating to that one that I told you that
Expense.
you borrowed money, you now paid interest. And I was emphasizing that it has to be money you borrow to construct, not to purchase, to construct. Because if it is money to borrow to purchase, that one expense, you expense it because the asset is ready. The one that you capitalize the interest is where you borrowed money to construct. That means it takes time for the asset to get ready. So let's go to note 3 and see what they have for us. So they said that Omega Co took out a loan of 12 million on 1st of October 2006 to partly fund the construction of the factory. The loan carries a rate of interest of 10% per annum. So what do we do? You took out a loan of 12 million at the
You
beginning of
capitalize.
Capitalized.
you capitalize. How much?
1.2.
That's wrong.
1,200,000.
1.2. 1.2.
Okay, you called it another name from 1.2 to 1.2. That's wrong.
That's what I mean.
Okay, that's what you mean. That's wrong.
Yes, sir.
I
So
think it's capitalized,
that's correct. So how
but
much is? I think everybody agrees that we capitalize, but how much?
so they said the
The
construction
10%
was 8 months.
of the
1.2 million.
1,200,000.
So it's going to be
1,200,000.
1.2 million.
times the 10%, right?
Okay.
I think it's
Okay.
8,12 times 10% of
12 million, I
Okay.
mean.
Okay. Sorry, sir. It will be 1.2 times 11 over 12 because this was up to October 2026. And then, no, sorry. The construction ended in May 2007. So we'll calculate the period up to that time and divide by 12 to multiply with the 1.2.
Opalakunle,
800K.
Opalakunle, that's correct. Yeah, the construction took 8 months, right?
Yes,
October to May is 8 months. And this
yes.
is 10% per annum. So you cannot capitalize the entire 10% per annum. That's for 12 months. So it is 10% of 12 million multiplied by 8 over 12. So you only capitalize the period up to the completion of construction.
800,000.
800,000. Correct.
Mr. Asim,
Yes, Latif.
mo take grace Ọlọ́run kéèyàn má omit gbogbo àwọn kéèyàn má skip gbogbo àwọn kọ́nà yìí.
Yes, sir. And practice. the funny thing is that if you have practiced past questions, you will have nothing will be new. Nothing will be new. So you will have mostly seen these things before. You just need to calm down, and of course, grace of God too. But practice, practice, practice. Right? Yeah. So which is why we are looking at the extreme cases in class. Okay. So, I mean, we have touched on all this scenario, and this is the solution here. I'm sure you have the notes with you. But there is one last one in note 4. There's one last one in note 4. So they say that the factory has an expected useful life of 20 years. At that time, the factory will be demolished. The site restored to its original condition. This restoration is a legal obligation that arose on signing the contract to purchase this land.
No, yes.
The expected cost of fulfilling this obligation are 2 million. An appropriate discount rate is 8%, which represents discount factor of 0.215 for 20 years. Okay, so you now give us 1.1 plus 8 raised to power minus n, explaining to us how they got this 0.215. So this is the formula for discounting. So I mean, without telling you, this is referring to that initial estimate of dismantling, removal, and the site that I was talking about present value. So, how much was the future cost? It's 2 million, right?
2 million.
Yes,
Yes.
sir.
So how much are we recognizing in our books today?
0.215 times 2 million.
Present value.
Thank you very much. Fantastic. Fantastic. That's correct. That's absolutely correct. Okay. So whatever you get will be expense. Sorry, will be capitalized as part of the costs. And I think that is 430. That's 430. Okay. So again, you will see that it is not all of these costs that we capitalized. Anyone that is not capitalized shall be expensed. Any cost that is not capitalized will be what? Expense. So we expense it. We expense it. Okay?
Hello,
Like,
sir.
yes, Temitope.
Sir, so when those ones that we agreed that we are going to expend, so basically answering this question, those ones that are going to be what's the word? We are not going to even use them at all. We are
Exactly.
going to treat them like they do not exist, since we are not trying to we are not going to calculate expenses, since we are trying to calculate the cost of this factory now.
That's correct. Yes.
Okay.
So we just omit and leave those ones.
Thank you, sir.
Okay. Latif.
Sir, you emphasized about loan specifically for purchase of finished asset with that of the construction of assets. But sir, both of them are loan for assets for the use of the business. Interest as per the interest on those loans.
Yes. Yes. So, I mean, yes, the difference is just when they are ready for use. The difference is just when they are ready for use. So, we just believe that if you had borrowed money to construct an asset, so we don't want you to be incurring finance costs as an expense in P&L. Because later I will still teach you, when I'm teaching you depreciation, I will introduce the concept of matching to you, matching concept, right? So for us as accountants, we want you to recognize item as expense when you can match it with a cost, sorry, with a revenue, with an income. So if you are still constructing an asset and you are now incurring interest and you want to start expensing that, let's say that's the sole purpose for which your business was established and you have started recognizing expense. No, that's against matching concept. Don't expense such. Capitalize it. Okay? as part of the costs of getting the business ready, right? So when that construction is then ready, then any further costs, then you can stand, because we believe that after it's ready, then you can start making money. The matching concept can then apply, and you can start expensing, then also recognizing income as the case may be. So that's why.
Okay, sir. So what happens to the principal? Would it just go to the statement of profit and loss as a loan?
Never.
I mean, statement of financial position rather.
Fantastic, yes. Yes.
Hello, sir.
Hello, yeah, Yusuf.
This restoration cost, the 430 that we got,
Yes.
while you were explaining that part to us before, I think you made mention of it of the fact that we are going to post it to provisions. So I want to ask, is it the same 430 that we capitalize that we're also going to post to provisions?
Yes, my brother.
Okay,
Debit,
sir.
credit, the same amount on the debit, which is what we're adding to PPE, the same amount to be on the credit.
All right, sir.
Now, when you have bought an asset and you've started using it, some costs might start surfacing during the year. Such costs, we call them subsequent costs. They are costs you incur further or subsequent to the capitalization or to the recognition of the initial cost of an asset. The key question we need to answer here is that these costs you are incurring after initial measurements or during the year or after acquisition or after the asset is ready for use. These costs you start incurring after. Should you capitalize this cost or should you expense it? IAS
Expense.
16 said that. IAS 16 said that you will capitalize these costs if they meet the two recognition criteria for recognition of PPE, which is it is probable that future economic benefits will flow to the entity, and the cost of the asset can be measured reliably. If they meet these two recognition criteria, then capitalize them. If they don't meet them, expense it. Expense such. And a typical example of expenses that will not meet these recognition criteria are assets, or sorry, are costs relating to day-to-day servicing or repairs and maintenance of an asset. Those ones are costs of just sustaining the assets, are costs to ensure that the asset meets its target output. They would usually be expensed. They won't generate any additional future economic benefit for the asset. Okay? They are only trying to ensure that your asset meets its target condition. It's just like if you buy a car, and that car, the manufacturer have told you that this car can use 5 years. You see, that 5 years is provided you maintain it and service it when you are supposed to. If you don't maintain it properly, it will not use 5 years. Okay, so day-to-day servicing or repairs and maintenance are just necessity to ensure that that asset reached its target limit. If you don't do it, it will not. Those kind of costs, they don't generate any additional future economic benefits. It's just ensuring that the future economic benefits they should originally generate, they are generating it. So which subsequent costs can generate future economic benefits? We are talking about subsequent costs that will improve the productive capacity of the asset. We are talking about subsequent costs that will improve the useful life of the asset. These are the costs that will ultimately be capitalized. For example, an asset that normally would have used 5 years, but you replaced a major part that will make the asset to now use 7 years. Sorry, I was hearing a noise. Okay, so an asset that ordinarily will use 5 years, you now incur the cost that will now extend the years by 2 years. That is a subsequent cost that should be capitalized. That is what we mean by generating additional future economic benefits. That is what we are talking about. And such costs will usually be the one you have to replace a major part, or the one where you are doing like an inspection, a major inspection. I mean, it's majorly replacement of parts. But in the exam, it's always very clear. The examiner will make it clear. They will tell you that after buying the asset, or maybe after 2 years, we now incur the costs. And these costs now improve the useful life by 2 years. They will tell you, or they will tell you that these costs improve the capacity of the assets by 200 units. They will be very specific. If you're able to spot that, okay, this is what Mr. Wasi was talking about, by providing additional economic benefits, then this, you should know that it should be capitalized. When you capitalize it, then you are fine. Then you are very fine. And that is what this guy is continuously emphasizing in this part. And take note of that, because we are going to be needing that knowledge later when it comes to subsequent costs. Okay. So the next one.
A question,
is,
sir.
okay, Olakule, ask.
Yes, sir. So if the cost incurred reduces the cost of servicing the asset, for example, probably a major part was replaced, and before then, that major part had already been always been giving problem that we had to be servicing every time. And now that the major part has been replaced, it will lead to increase in the useful life of the assets, and it will help us to, stop incurring the maintenance cost. So to an extent, it has reduced the cost of maintenance. Would it also fall into this category?
Of course. Cost reduction is economic benefit. It's cost savings. So definitely, we will capitalize it. It has saved us cost. It has brought in economic benefit. Good question, Anakule.
Sir,
Okay, Temitope, go ahead.
okay, using motor vehicle, for example,
Okay.
if we have to change the engine of that motor vehicle, since basically it might have to increase the useful life of that motor vehicle, but it's a fresh engine, so basically it should. I just believe that. So that kind of expense now, when we are recording it this year that we bought that engine, do we record it as additional costs that year? I mean, how do we add it to the cost of that motor vehicle? Because we've already bought the motor vehicle like 2 years ago, and we are just changing the engine this year. I don't know if you get my question clearly.
Very well, I get your question clearly. So accounting softwares will make it easy for you. So you'll have like a chart of accounts, and good. Fortunately, a lot of systems will use costs or historical cost basis. So the cost is there. So you just enter it as an additional cost at the date you incur it. It will just increase that cost, right? As at that day. It's a position thing, right? So it just increases the cost. So, but of course, it will be in that when you print the GL or the breakdown of that expense or or of that item, you will see that, okay, in 2017, okay, we bought it, this one. In 2018, we incurred additional cost of this. Then the total will be, that breakdown will be there, but it will have added to the costs, right? So that's how it would work usually.
Okay,
It's not
thank
like
you,
I
sir.
explain the existing one and cancel it out. No, it just increases it. It
Okay,
just
sir.
additionally. Okay.
Thank you.
Now the next one is subsequent measurements. Don't forget, I told you that when it comes to measurement, we have initial measurement, which is the measurement at the date of the transaction. And we also have subsequent measurements, which is measurement at the end of the period or at the end of the year. That is what we call subsequent measurement. And it's this subsequent measurement that we use when we are preparing our accounts at the end of the year. So how do you measure an item of PPE at the end of the year after you have initially measured that item? This standard says that is either you measure it at cost or at fair value. You choose either of the two. For the costs, we call it cost model. For the fair value, we call it revaluation model. So when I say cost model, for the fact that it's a model, that means we are probably talking about a formula or an expression. Then we are saying that PPE is carried at cost less accumulated depreciation, less accumulated impairment losses. That is cost model. Cost less accumulated depreciation, less and accumulated impairment losses. Anytime, any day, if an examiner asks you to define and explain cost model, it is no more than this. Cost less accumulated depreciation and any accumulated impairment losses. You don't need stories. And usually, cost model will result in something we call carrying amount. So by the time you do your costs, less accumulated depreciation, less accumulated impairment losses, the resulting figure, we call it carrying amount. Revaluation model is carrying the asset at revalued amount, which is usually the fair value of this asset at the date of revaluation, the fair value at the date of revaluation, less subsequent accumulated depreciation and any accumulated impairment losses. So revaluation model is carrying it at revalued amount, and is usually the fair value of the assets at the date you revalue minus subsequent accumulated depreciation and any accumulated impairment losses. You see, the examiner takes this subsequent accumulated depreciation so seriously that in the exam, if you mistakenly omit or not put it, he would tell you are wrong. Subsequent accumulated depreciation. So for now, I can't start explaining why subsequent. I will explain it next week, Thursday. We will be there already. That is when I will explain what I mean by subsequent accumulated depreciation to you. Of course, that will be next week. Okay, so that is
So,
that's the subsequent measurement.
oh,
Okay,
sorry, sir.
yeah, luckily.
So please, can you explain what accumulated impairment losses mean?
Okay, so for now, just take it as impairment losses. It's a separate topic that I will still teach you. I will teach you each of these. Everything I've mentioned here, everything I will teach you. But everything is step by step in my class. So I will get there. So luckily, just hang on. So now, You see, these two choices, you have to choose one at the end of the first year, and you have to be consistent with it. Don't forget, one of the features of financial statement is consistency of presentation and treatment. So when you choose cost model, you must continue to use cost model till the useful life of the asset ends. When you choose evaluation model, you must continue to use that evaluation model till the end of the useful life of the asset. So we do not encourage that you change. You cannot change cost model or evaluation model. You choose one of the two. Now, you will see that for the cost model, we said is the cost less accumulated depreciation and any accumulated impairment losses. There are three items in question here: costs, accumulated depreciation, accumulated impairment losses. And when I say three items, that means three different accounts. Three different accounts. So that means there will be an account for costs, which does not change. When I tell you that an asset is initially measured at cost, that cost is what will be in that account forever, except if there is additional cost. But it's going to be that cost at the end of the year. So there is an account for costs of the asset. That will be the asset account. There is something we call depreciation, accumulated depreciation. There is an account for that too, which I'm going to start talking about very soon. That also is a separate account. There is another account called accumulated impairment losses, which I will teach you, I think, in the next 3 or 4 weeks. IAS 36 is also a separate account. So this cost model is not like a singular figure that we have in an account, but rather is something you do in what we call a fixed asset schedule, where you would determine the carrying amount of that asset using a cost model. And I told you that when you do your cost less accumulated depreciation and any accumulated impairment losses, it gives you carrying amount. Is that carrying amount that you take to your statement of financial position. And the way or where you get this carrying amount is from a fixed asset schedule or a PPE schedule, okay, where you have the costs. You go and pick it from the cost account in your GL. You have your accumulated depreciation, which you pick from your GL. You have your accumulated impairment losses, which you pick from your GL. So this cost model is just a schedule that you do in your notes. So they are separate accounts. I need you to appreciate and understand that these are separate accounts. So cost model is just taking from your cost account how much, from your accumulated depreciation account how much, from your accumulated impairment loss account how much. This is done in a fixed asset schedule. The same thing for the revaluation model. It's the same. The only difference is that this one considers fair value, not the cost. I would explain evaluation model separately, not today. Fair value, separate accounts, minus accumulated depreciation, but here is subsequent. I will explain to you next week why subsequent. Separately, accumulated impairment losses, separate account. It gives you carrying amount or revalued amount for evaluation model. Okay? Now, for today, both cost model and evaluation model, two things are common. One is accumulated depreciation. He has it here, and he also has it in the evaluation model too. Two is accumulated impairment losses, is in the cost model and is in the evaluation model too. But I'm not going to talk about impairment losses in IAS 16. I would leave that till IAS 36, but it's something that do exist, impairment losses. I don't want to go into that for today. So here in IAS 16, Mostly we'll be focused on cost minus accumulated depreciation for the case of cost model, and fair value minus subsequent accumulated depreciation for the case of evaluation model. So now, the first thing we then need to look at to get our carrying amount at the end of the year is a concept called depreciation. So what is depreciation? IAS 16 said that depreciation is the systematic allocation of the costs or depreciable amount of a non-current asset over its estimated useful life. Systematic allocation of the costs or depreciable amount of a non-current asset over its estimated useful life. So I'm going to break down this definition to you, comprising of systematic allocation, cost or depreciable amount, and estimated useful life. I'm sure a lot of you have this misconception that depreciation is the loss in the value of an asset, or depreciation is the reduction in the value of an asset. Never. That is not what depreciation is. Depreciation is not a loss or a reduction in the value of an asset. It is far from it. Depreciation is just an accrual or matching accounting technique, okay, that helps you allocate the depreciable amount of an asset to the period expected to benefit from the use of that asset. You know, somebody asked me the other time that you have not started using an asset, okay? And I'm saying that interest costs or borrowing costs should be capitalized for when you are constructing the assets. But when the asset is ready, or when you are buying an asset on the shelf, that even if you borrow for that, you expense that. Is it not borrowing for the same asset? I said, no. You see, the one that you are incurring cost, while you are still incurring or constructing the asset, we don't want you to start expensing anything because the asset have not started generating money. So don't put anything in P&L yet. Capitalize everything. Okay, see, that scenario is similar for depreciation, because now that the asset is ready for use, an asset that we have constructed, we have spent 100 million to construct, and now the asset is ready. And the assets, we have estimated that this asset, we are going to be using it for 5 years. When we say we are going to be using it for 5 years, that means that that asset is going to generate money for us for 5 years. That means every year, there will be a form of income that will go to our P&L. Accounting requires that for every income you recognize to P&L, it has to be matched. It has to be matched with a corresponding cost. So when you have incurred 100 million and you have capitalized it and suspended it as an asset, you don't just leave it there forever. That cost, the reason why you have put it as an asset is because it's not a cost that relates to a year. It's a cost that relates to many years. So it is expected that you do not put it in P&L and eat it on 1 year's profit, but rather spread it along the profit of those 5 years. And the way we do it is through depreciation, is by a way of matching and also accrual. Matching in the sense that this asset has generated income for 1 year. Then what is the portion of the costs that relate to 1 year? We call it depreciation. Accrual in the sense that what portion of this asset have we used this year? Because we are using it for so many years. What portion have we used this year? We call it depreciation. So depreciation at your level, don't see it as a loss or reduction in the value of an asset. That is not what it is. Because even an asset that is increasing in value, you will still depreciate it. So depreciation is just a way of saying that what portion of this cost now have we used? Then let's put that portion in P&L. So that means over 5 years, you will have put the entire cost in P&L. That at the end of the 5 years, the carrying amount of that asset will now be zero. Then fine, everything cleans out intelligently in our books. So depreciation is just a matching or accrual accounting technique that we use to allocate the costs or depreciable amount of an asset over the period that is expected to benefit from the use of that asset. Okay, that is depreciation. Now, breaking it down further, we said depreciation is the systematic allocation of the cost or depreciable amount of an asset over its estimated useful life. 3 items are sacrosanct here. The first is systematic allocation. The second is cost or depreciable amount. And the third is useful life. Now, the easier one is this cost or depreciable amount. So when we say depreciable amount, we are talking about the costs, okay, that you are expected to depreciate, or we call it the cost less estimated residual value. Cost less estimated residual value. That is the depreciable amount. So when we say residual value, we are talking about the amount that the entity expects to obtain from the asset at the end of its useful life. We are talking about the scrap value of an asset. We are talking about the portion of the asset that we will not use, that the money we will get from it is from selling the asset. We are not using that portion. So that portion, since we are not going to use it, so it will not eventually find its way into P&L. It's not something we will depreciate. That is why the depreciable amount, which is the portion of the cost that we are actually depreciating, is the cost minus that portion we will not depreciate, which is residual value, which is what we will obtain at the end of the useful life of the asset, that after we have used this asset, whatever value is now remaining is residual value. That we are not using it, so there is no point depreciating it, because the whole idea of depreciation is that the portion we have used, let's expense it. The portion we have used, let's expense it. Of course, the remaining portion that we are not going to use, we call it residual value. So your depreciable amount is cost less estimated residual value. Now, the third one is estimated useful life. Now, this estimated useful life is also the period over which you are expected to use the asset, or it could be in form of the number of units that can be derived from an asset. So useful life doesn't necessarily have to be number of years. It could be number of units. Okay? So when you have an asset that is supposed to spend 5 years, fine, that's useful life. Also, when you have an asset that can produce 100,000 units, that is also its useful life too. Okay, so, and when we talk about useful life, a lot of things can determine useful life of an asset, from how you use it, the level of usage, to your maintenance culture, to if there is any contract that places legal limits on the use of an asset. Okay, so if you have acquired the asset and there's a contract that says that you can only use it for 3 years, so as far as you are concerned, that's the useful life. Or technology or obsolescence can also determine the useful life of an asset. Also, the quality of the assets can determine the useful life of an asset, and also the useful life of a similar asset can also determine the useful life. So why I'm intentionally giving you this is because I kind of asked it before, that what are the factors that determines the useful life of an asset for 4 marks? They asked it in 2023 May, right? So a lot of my students came back with it, and they were able to come up with some good points as far as this is concerned. So we have broken down depreciable amount, okay, which is cost minus residual value, and estimated useful life. So one thing I just need you to note about useful life is that it's always based on estimate. That's why they call it estimated. And we have to always determine it at the beginning. Immediately you buy the asset, you must determine the useful life. If you don't determine it immediately you buy it, there is no way you can depreciate, okay? And also is depreciable amount. That residual value, practically, I've never seen any of my clients that I prepare audited account for. We don't even bother ourselves about residual value. Nobody wants to be carrying out the stress of saying, okay, what portion of the asset are you not using? How much would, after we have used it, what will be the remaining value? Residual value, as far as I'm concerned, is just a theoretical exercise. I mean, it's only in exam you'll find it. Practically, you will not meet it, except if you just want to stress yourself. Cost is cost. Nobody is ready for any cost minus residual value. But in the exam, they will give you. And again, it's also an estimate. It's also an estimate. And an examiner might even want to make you understand that since it's estimate, it can change. Because an asset that you estimated was going to use 2 years, or let's say 5 years, after using it for 3 years, you could realize that you can even go further. Then that means you can revise that useful life. The same thing as residual value too. It can be revised. Okay, all of this revision will have impacts on the ultimate calculation of depreciation, which I will show you. It's nothing serious. It's quite straightforward. So that's that. And also is systematic allocation. So this systematic allocation is just how depreciation will be calculated. Okay, that's just how you allocate the depreciation, and which we call depreciation methods. So IAS 16 recognizes 2 depreciation methods. I'm sure you will read some textbooks that will give you 7 types of or method of depreciation. Well, good luck. IAS 16 recognizes 2 methods of depreciation, and that's what we're going to talk about in this class. Number 1 is straight line method, and number 2 is reducing balance method or diminishing method. And it is these 2 methods that would be examined in an FR examination. And ultimately, the choice of which you use depends on the pattern with which the asset generates money. Okay. If the asset generates money equally, we use straight line. If as the asset gets older, the money it generates gets smaller, then you will use reducing balance. So ultimately, the choice depends on how the asset generates money. And when we are talking about depreciation, you can only depreciate a depreciable asset. Okay, so I kind of asked you before to list the characteristics of a depreciable asset. And from all my explanation, a depreciable asset must be used for more than 1 year. A depreciable asset must have a limited useful life. An asset that is useful life is unlimited, you cannot depreciate it, because how do you want to allocate? How much are you going to be? There has to be an ending date. Otherwise, if it's to infinity, there is no way you want to know how much you are putting to each year. So you cannot, it's not a depreciable asset. And also is that the asset be held in the production or supply of goods or services, or rentals to others, and for administrative purposes. So that is a depreciable asset. They can ask you in the exam, so be ready for them this. Okay, I saw your hand. Actually, see, when you raise up your hand, I see it. I don't know how to finish. before I call on you. Okay, Olakunle, go ahead.
Yes, sir. I just want you to go over the explanation of I mean, when you are talking about the amount determines the method you are going to use. I mean, whether you are going to um, measure it on a straight line basis or on reducing balance.
Okay. So that's the systematic allocation, the method of depreciation. The choice depends on how the asset makes money, or how the asset generates money, or the pattern of economic benefit from the asset. Okay, so if an asset generates economic benefit equally through its useful life, then you will use straight line method. You will use straight line method. Straight line method. However, if an asset generates higher inflow at the beginning of his life, okay, than later, then you will use reducing balance method. That's why they call it reducing balance. So, I mean, the ideology is just so that you are matching like with like. Okay, since the whole essence of depreciation is just matching the revenue from an asset against the costs. So the depreciation is the costs. So if the revenue, you are recognizing it equally, then the cost too should be recognized equally. So if you are recognizing an higher revenue in earlier years, then recognize an higher cost in earlier years. So that's the determination, or how you choose either of the two methods. All right. I can see your hand. Go ahead.
So, you briefly talked about the depreciable asset, that a depreciable asset must have a useful life, estimated useful life. What about there are some okay, like a software now. First, how do we classify that kind of asset? What class of asset? And then how do we integrate the cost and the estimated useful life into the this thing? Because at times I saw that some companies, they don't, because that kind of asset doesn't, except that we have the renewal of licenses. Maybe you have to use the software for like 3 years, then you have to pay for renewal again. So they don't really have a useful life in terms of depreciation. I don't know. So it's somehow confusing.
Okay. So software is not a tangible asset. So it's outside the scope of what we're talking about today. I will still teach you about that. So I will not talk so much about it. So but to limit it to what we are doing today, an example of an asset that has that we do not depreciate is land. That's not a typical one that you would find. So, and the reason we don't depreciate land is because land has an unlimited useful life. So in financial reporting, we believe that it has an unlimited useful life. Some other people will tell you it's limited, and whatever stories they have behind that, we don't believe that. And you also should not believe that. It has land is there forever, whether erosion, whatever, it's there for it. It's not going anywhere. So it's there. So it has an unlimited useful life. So we don't depreciate it. Okay. So before you can depreciate, the useful life must be limited.
Okay, sir. So what about leased land? That probably you lease it for a period of years, maybe 99 years. I mean, we can at that period, determine its useful life. I mean, when you have when you say you have the benefit and the risk are now yours over that land, it should be categorized as an asset, and the useful life can also be measured.
99 years. So you and who want to be depreciating an asset for 99 years?
No, I'm just saying. I'm just saying.
Ara, it has unlimited useful life. Everybody should have been dead by then.
Hello, sir.
Yes, Latif.
Yes, I have a similar question because
Okay.
in our organization that I'm working, the free trade zone, in which the land is not is on lease for 50 years.
Even if
So
it is,
in that case,
even if it
so what?
is, even if it is on lease for 1 year, don't depreciate it. See, I'm saying this intentionally, right? I'm still going to teach you IFRS 16, right? Leases. I'm still going to teach you IFRS 16. So I just want to take your knowledge step by step, step by step. So when we get to IFRS 16, you now understand it very well in that context, right? But for today, land has an unlimited useful life. Land and unlimited useful life. So for the most part of it. So when it now comes to a leased asset, okay, there is a lot of story behind it because the dynamics is entirely different. The way we determine depreciation there is different. So if I start introducing that here now, let's wait till that time, then you will see it. So for now, for today, just see land as land. Okay, leave all the other encumbrances alone. Land is land, right? Everybody knows that anywhere, any state is 99 years. You don't own the land forever. Land belongs to the government. Everybody knows that, right? So in some states, it might not even be 99. It depends. But land is land. Unlimited useful land. So let's leave that. And our time is fast spent. So I think I will just allow you guys to. So next week, we are going to finish up next week. Today's class was broad, detailed from my perspective. We have a long way to go. Hopefully, we would be as effective as this next week. I appreciate you guys for your participation. Just that I really very few of you are participating. That's not good enough. I have quite a lot of students here. So others should also improve your participation, except if you are just getting everything we are saying and everything is sinking. That's quite okay. But every one of you must participate. Every one of you must pass, right? So go and read what we have done today. Next week, we're going to finish it up. So if I don't have any other question, so I guess we can go and sleep.
Thank you, sir.
Thank you very much, sir.
Bye.
Good night, sir.
All right, thank you.
Good night, sir.
Thank you, sir.
Yeah.
Good night, sir. Thank you.
Right.